Hello and welcome to your business through the buyer's eyes. My name's Ed Meisigland. I'll be speaking to you today. Um, I just wanted to let you know our brokerage. We've been doing this for about 40 years, and the interesting thing and why this topic came up is after a little over 2,100 transactions, we continually uh, see that the most successful business owners or successful sales are when a seller can see how a buyer is looking at their respective business. And we've always said, if you can give me a willing buyer, willing seller, somehow some way we'll put the deal together. So so that's what we're going to talk about today. So as far as about me, I'm a business appraiser. I'm designated in exit planning. I'm a certified value builder. And exit planner, as well as a business appraiser. And so I spend most of my waking hours dealing with value and how value is going to be transferred. So so let's just jump right in. And like I said, we're gonna do a deep dive into what the buyer's looking for. And so the takeaway for today is that there'll be a little bit of homework at the end of the presentation about how, now that you've heard this, I want you to go back to your respective business, or maybe even grab your spouse or your partner and evaluate your own businesses based on what we talked about. So Chelsea is manning the chat box. So if you have questions, send them over. She will be sending a copy or a link to this webinar. So if you have to jump off, that's fine. I anticipate we're probably going to go 30 to 35, maybe 40 minutes tops. And so, like I said, if you have to bail, that's fine. We will. You'll everybody that registered will receive the link. Okay, so let's get moving. So the first thing we have to do is get our minds right. And when I say that, we have to, when you're looking at your business, you have to look at it through the buyer's eyes. So position yourself as, what would make a buyer want to buy my business, rather than, can I have enough attributes to sell it to them? Can I convince them to sell it? Now let's look at it the other way. Let's look at why a buyer would want to buy your business. And so we're going to we'll start there. What is the buyer? When we look at buyers, we look at, there are three types. Okay, so there's three buckets of buyers. We have individuals, we have private equity groups, and we have strategic buyers. Now, these strategic buyers and private equity groups kind of fall into what we call strategic or synergistic type buyers, where there is that mentality of 1 + 1 = 3. Um, and so we'll talk a little bit about that here in a couple slides from now. But like I said, there's three buyers that you need to understand that your business might apply to: individuals, strategic buyers, and then private equity groups. Now, let's start with the individuals. So when we work with buyers, I can tell you that the majority of the buyers that come through our shop is, they plan to be full-time owners. And what what causes that? They either, they're displaced. They've been downsized or something like that, where there's a forced exit, or a voluntary exit, taking early retirement. We're seeing, believe it or not, we're seeing the average age of the buyer pool going up. um, that people want, after they have a retirement, perhaps they want to get back, they want to do their own thing. We see a lot of people that, like I said, are disgruntled, and they want to go, I'm never going to be, you know reviewed like that again. I can do the business better than they can. I want to control my own destiny. That's the type of person that we're talking to. um, so the second thing is they can't pay cash for your business. And we here in the next session or two, we're probably going to talk about how financeable your business is, or how to look at your business from a financing standpoint. And we may bring a lender on to talk about that. But for our purposes, in talking about how the buyer looks at your business, this buyer, like I said, can't pay cash, but they can get qualified for a loan. So the question that we're always faced with, and especially for you that have, junior partners or a second tier of management that that are capable, that just may not have the equity. I mean, the lending environment right now is extremely robust, and when I say robust, I'm talking 5 to 10% down payment, or equity injection. I shouldn't say down payment, equity injection, to qualify for a business loan. So keep that in mind as you're looking at, who's my successor. Is it but do you call someone like us and say, we want to sell the business, or do you have someone internally that might be a candidate to pick up where you're leaving off? So like I said, in this case, with this financing for the individual, they're borrowing probably money from their home equity line. There's options with 401k, family and friends. So they're compiling. They may be great operators, they just may not have all the cash. So when you're evaluating your potential exit and you look at who's the likely buyer, I certainly don't discount the individuals. And then lastly, it needs the following: can it pay a reasonable wage? And a lot of buyers that we talk to, I mean, they're okay taking a little bit of a um, financial haircut to control their destiny, but at the same time, it has to be commensurate with the risk associated with buying the company. So they have to be able, they're not going to, go from making $100,000 to $25,000 because that's what it's going to take. But they might go from 100,000 to 80,000. So but it has to pay a reasonable wage. The next thing is, can it support the debt? So when we look at a business, and for those of you that were on our session last time, we talked about how to construct your adjusted cash flow, because that's what the buyer is going to be using to evaluate the opportunity. So can it pay my wage? Can it service the debt? And then lastly, what is the return that I can expect um, on of my investment and on my investment? Because what you don't want to do, or what's going to kill a deal, is that if let's just take for example, I get a severance package and I have $100,000. So what is going to induce me to invest in a small business? Well, there's a number of things that work. One, okay, I want to control my own destiny. Two, I can take this money and I can buy, $1 million company. Well, now when I look at the merits of the business, can I get a return? Now, it's not on any of these slides, but I'll tell you that, the return on investment, should be north of 20-30% based on the risk associated with just small business in general. So, keep that in mind, because we all have to make the numbers work. And again, the returns are based on risk. So that number, the number, between 20 and 30%, again, that's rough. It depends on the risk tolerance of the buyer. All right, let's talk a little bit about strategic buyers and private equity groups. So what I need, let me back up. When we talk with a lot of business owners that may be candidates for someone to acquire them, like candidates, not individuals, but strategics or private equity groups, they assume that a company that's roughly the same size as them is the likely candidate, and in fact, that's not the case. It seldom is the case, but that's okay. I mean, there are outliers. I'm not saying it doesn't happen, but I'm telling you, as a general rule, you size matters when you're talking company buying another company. And the rough rule of thumb is at least 5 times the size in revenue than you are. So let's take a look at these. So the first one is, and again, these are questions to ask well, whether or not you're going to be a candidate for a strategic or private equity group. And for those of you that don't know, strategics are consider a buyer that is another company, supplier, or someone in which the benefit through the acquisition would be a 1 + 1 = 3, meaning that there are economies of scale, and as a result of that, they the acquisition is amplified, and probably the value is also. Private equity groups are professional acquirers. Typically, there is a portfolio of businesses within that portfolio, and the private equity group acquires and has almost an internal, through the portfolio, an internal synergistic effect. And again, they're professional buyers. Their intent is to build efficiencies, strategies, development, and then eventually sell it. Their intent is always to build it to sell. So as we're looking at these two types of buyers, the first one is who makes money when you make money. So think of your supply chain, and it doesn't matter what your supply chain is. Just think of who from beginning to end, who would benefit from acquiring you, and just make your list of who and why. The next one is who doesn't make money from you. Like in this case, who would not make money when you make money? Well, that person that you identify, or that company that you identify, that's that person that would benefit as a 1 + 1 = 3 scenario. Who can make more money than you can from your products? Now, this is where the private equity group comes in. So think of that scenario where, by adding different businesses and having the synergy between them, that facilitates the cross-selling opportunities. So next is, who can remove a constraint on your business? Now think of capacity. Often we're seeing, if there's a particular business that is at capacity and they can acquire another company or be acquired by another company and move that whole facility into a situation where there's excess capacity, it's a big win. They pick up all of the rent. There's where the synergy lies. We'll talk a little bit more about technology in a second, but who can leverage technology? How about geography? So if you're constrained from a geographic standpoint, we see this in sales organizations, I'm just going to buy another territory. Okay, so I have Michigan, somebody else has Indiana, I acquire it, and now my synergy is built in to geography. And then lastly, do you have other products or services that would facilitate a synergy? And I'll talk a little bit more about that here in a second. So next, who has a problem you could solve? And again, this was, as I was writing these slides, I was trying to think of, what are all the questions that we always hear. And again, you're in business to solve someone's problem. Totally get that. Well, what problem do you solve for another company, perhaps a competitor? What can you, or a supplier, or another type of vendor? And this is probably a good a good spot to stop this. And the reason I'm putting the brakes on is because I should tell you that when approaching strategic buyers, okay, and competitors, it is not just a matter of picking up the phone and calling them, because depending on that competitor, you're going out of business. You're not looking to exit your business. They're looking at it from a competitive advantage. So I urge you, in fact, I implore you to tread lightly when, if you're planning on doing this yourself, make a truly make a strategy that will preserve your confidentiality. It's one thing, hey, let's have a beer and let's talk shop. It's an entire another thing to be leading off that, look, I'm looking at exiting and I think you would be a great fit for us. Well, I'm just telling you, after nearly 40 years of doing that, that is probably not the way you want to approach it. So again, I should have mentioned that at the beginning, that this is dangerous territory that you're dealing with. Okay, so what threat can you reduce or eliminate? The various threats that we're talking about are, um, as you consider your business, and each business is different, and each business has different, we do a SWOT analysis, because that leads us to where our synergies lie. So if you look at strengths, weaknesses, opportunities, and threats, you can, and just chart those out. That will lead you to what threat can you reduce or eliminate. And I know that's kind of vague, and we'll talk a little bit more about this here in a few slides from now. So cross-selling, that's always the big, that seems to be one of the number one reasons for a synergistic acquisition, and that is, who can benefit from cross-selling clients. We sold a janitorial company a couple of years back, and and that company went on to start buying pest control companies, and because they were servicing buildings and such, and they were, why not offer pest control services? So that was what they did. So in their trajectory of their company, they were out acquiring janitorial companies. They then moved into buying out pest control companies. So another example was, we had a durable medical equipment company acquire some home healthcare companies. Well, because they were going to be able to take their equipment and put it in the home healthcare. And so you can see where the same customers were serviced. So your sales force had new product offerings, and it didn't require the addition of additional people in order to accomplish that. Okay, so who uses the same technology as you? This is more industry specific. We see it when there's some customized um, applications out there that, you know just by virtue of the service that you provide, or the product that you provide, there are custom platforms or technology that has been developed, and acquiring that technology will facilitate efficiency that then lead to amplified value. So who needs your customer base? Interesting is, and this is probably the most difficult one to secure, and the one you probably want to be most sensitive to. I mean, getting access to your customers is, in our world, that is one of the last, if not the last thing that we do during the sale process. We sanitize all of the buyer profiles. For example, like in our case, when we're marketing, you know Eli Lilly is, you know uh, Midwest pharmaceutical manufacturer. Now it could be a bunch of them. We know it's Lilly, and so, but my point is that we want to make sure that that information is kept close. And again, back to you, if you're looking at doing this yourself, sanitize. And when I say sanitize, just it's either customer one, two, three, or four, or customer A, manufacturing company of widgets, customer number two, Central Indiana Injection Molding Company. Pick however you want to describe it, but whatever you do, you don't want to lead with this is the name. Okay, so as we're looking at the same customer base, again, you want to who benefits from your customer base. And again, it's back to the 1+1 = 3 and cross-selling opportunities. Now I know, like for us, there are different trade associations and consultants that serve those areas. And the funny thing is, like, there, and I'm friends with one of these guys. He goes, "You have no idea how many people call just to get my customer, want to buy me just to get my customer base so they can get the introduction, because the cost associated with client acquisition is far greater than the purchase price of my business." So anyway, keep that in mind on customers. Now, the last thing, again, we talked a little bit about it, what technology, and it's back to anything proprietary. I mean, that is an intangible asset we need to consider. And you know, we see that with IT, people that have that are knowledge workers. That is important. And again, as far as people go, I mean, people create the value in your business 9 times out of 10. And when we see various businesses that, you know, unfortunately, so many employees of sellers think that because they saw a pretty woman and that they come in and they buy the company, and the buyer fires everyone and they sell it off for pieces. Well, that's not how this works. You, Mr. and Mrs. Employee, you are the most important person in this equation, or it's certainly pretty close to the top, because without you, I can't create value. So we need to be sensitive to that, with why are they acquiring people. And again, it may be various different reasons, but just be sensitive on the employees also. And again, back to how we operate, we sanitize that. Again, employee one, been with the company 20 years, making 150 grand, responsible for day-to-day operations. And we could work our way through the through all of the employees down to, just, to the last guy on the totem pole. And again, in our world, it's confidentiality, and in your world it should be too. Okay, so let's talk a little bit about drivers of business value. And I've touched on this, alluded to it in some of our first 4 or 5 webinars. I'm not gonna do a real deep dive, but I do want you, as you're evaluating the buyer's eyes, I want you to think of these 8 drivers that we utilize day in and day out to assess value. So the first, again, financial performance. You can't get around, you know, uh, the results are what they are. So the question is, how do you fix it? How do you measure it? Well, we're measuring it against the industry. We're measuring it against other companies that have sold. We're measuring it against, um, just you against yourself. How have you performed? What has happened? Because that's what you're selling. So when you're looking at your business, look at the financial performance. And again, yesterday, the last session, we talked about how to evaluate your company, at least the income approach or the income statement, so you can see what changes have been made or what changes are happening year after year, so you can tell that story. um, you got to paint a picture for the buyer, because confused buyers don't buy. Okay, so again, we're looking at history of profits, and something that we're going to talk about in depth next time is record keeping. The due diligence in our world, time kills all deals, and it will kill your deal too. And so we're going to talk about all the documents that you need to have available in order to keep the deal moving forward. Okay, next, growth potential. As you remember, the last time we talked about value is present value of future benefit. So what does the next year or 5 look like? Is it growing? Where are you in the life cycle of your company? Is there new competition? That's why we do the SWOT analysis, because we want to know what the threats are. Because, and again, when we're talking about strategic buyers, we're talking about consolidation. There's opportunities when additional threats come in. There's greater, size matters when you're competing. Okay, so what's your industry doing, and where are you positioned in the industry? And you may not know. You may just be a business owner with your head down and rocking day in and day out, and you don't pay much attention to what the rest of the world's doing. Well, the buyer is going to be doing a bunch of due diligence, trying to figure out their respective investment and how it's going to play into the next 5 years, because typically 5 to 10 years is the payout back to the bank. So as we're looking at the business, we need to put you into a position where we know, or at least have an idea of where this business is going. We ran into years ago, print shops. All of a sudden everything's going digital. Well, what do you think what happened to print shops? Well, they had to morph into something else, but in the meantime there was a lot of print shops that went out of business. Okay, so Switzerland structure. So we need the reason Switzerland doesn't have any allegiance to anyone. Switzerland does what it does. It just is its island. And what happens, and the reason it's called that, is for us it's dependency. You need to evaluate, is it dependent on you, your employees, suppliers? Where are your dependencies? And again, the question I always ask, if it goes away, what happens to the business? It doesn't matter if I'm talking about an employee. It doesn't matter if I'm talking about a supplier. It doesn't matter if I'm talking to a customer. What happens to the business if X, Y, or Z happen? And as you're evaluating your company, ask the same question yourself. What happens if I lose Joe's business? Well, if Joe's business is 80% of your business, you're in hot water. If Joe's business is 8% of your business, okay, well, I got to go find another Joe. You get the picture. Okay, the valuation teeter-totter. The reason I include this, this is about each buyer has to write 2 checks. They have to write you a check to acquire the business, and number 2, they have to write another check to fund the business in working capital. So when we're talking about a few slides back, the financial performance, what we're trying to do is assess this situation where we can understand how the business makes money, how the business flows, and is there friction in this process? Because the worst thing that can happen is a buyer buy a business and be undercapitalized. Okay, so that's why this valuation teeter-totters, because the value in the acquisition is one thing. Running it day to day and having the capital and understanding how money flows through the business is an entirely different option, and being able to optimize that only amplifies your value. Recurring revenue. Everybody's talking about recurring revenue these days. For it's funny. I got a call after our last webinar about talking about recurring revenue, and this person actually was under the impression that they're not going to be able to sell their company because they don't have recurring revenue. It's tough. Recurring revenue can mean a lot of different things. At the end of the day, when we're talking recurring revenue, do you understand your customer, and do they will they buy from you again? What is the life cycle of your customer? And that's one of the challenges that we see. And there's John Warrillow wrote a book called The Automatic Customer, where it has nine different styles of recurring revenue models that could be deployed in your business. So again, that and Chelsea will have the link in the notes. It's called Automatic Customer, John Warrillow. Next, so what makes you different? Why do people come to you? So this is the monopoly. I mean, there's different reasons that people come to you. If you're just garden variety, you know, your value can't increase. But if you do something special, it's entirely different. And for example, and I'll use a Subway versus a Quiznos, for example. If you have a Subway, the Subway, and they both do the same revenue, they both have the exact same cash flow. So which one's worth more? Well, the Subway's worth more because just by virtue of there's something different and special about them. Maybe it's branding, maybe it's just how they're approaching their new business model. But what makes you different is where your value is, that you're just not garden variety. Okay, customer satisfaction. Again, this is back to, do you understand your customer and how do you get them? And are they satisfied with what you do? Being able to be in a position to explain to a buyer what makes your business tick and why they come to you and what they like most about you, because then you turn around and you double down on what they like, because if they like it, they're going to tell their friends. If they tell their friends, your business increases in value. Hub and spoke. This is probably the biggest deal killer ever, is that the owner is the business, and everybody hears this, and sometimes you can't do anything about it, but you just need to understand how a buyer is looking at it. If a buyer cannot replace you in a easy manner, and all the relationships, all the intelligence, all the secret sauce of the business is you, well, we have to figure out how to get that out of you and to the buyer. That's because that's what they're buying. So what are you going to do about it? Well, from our standpoint, what we're doing is we're looking at structure. And you may not like the structure, but from a buyer standpoint, they're trying to mitigate the risk. You're trying to maximize the value. You hold all the value in your head. How do we get from point A to point C? Well, we're going to have to talk maybe in an elongated transition. Maybe we're going to have to talk, different introductions to suppliers, employees, whomever. So keep that in mind. But being the person in the middle and everything circles around you, that's where the hub and spoke comes from. That's a challenge. So everybody, one of the things that I shouldn't say everybody, one of the questions I get a lot is, how do I know if this is something that afflicts my business? I simply say take a week or two vacation and don't call the office. That'll tell you whether or not nothing, hopefully the business doesn't fall apart. But at the end of the day, this doesn't, that will ferret out whether or not you have a hub and spoke issue. Okay, so since we're coming to the kind of the end of this, here's the homework. So my mom used to make me do a T-chart. When I was struggling with a decision on what to do, and I'm certain your folks did the same. Make a T-chart. On the left side, factors working against the deal. Right side, factors working for a deal. Just list them out. I just gave you nearly everything that you should be thinking of. All right. So again, and if you want, email it over to us. I'll be happy to review it with you. I mean, I'll let you know if I got to turn the meter on, but that's what we do. And so For those of you that are first timers here, look, we've been doing this for nearly 40 years. We have an open shop. We we're serving the business owners, and our philosophy is the more we give, the more we get. So if we can help, we want to do that. The second thing is the second thing we have is a gift for you. So if you go to valuebuilders.us, I'm a certified value builder, and we have a self-assessment called the Value Builder Score. And we utilize that with nearly every one of our business owners. And what we want to do is that self-assessment is going to tell you the chinks in your armor. It's going to we're going to give you a report that will say X, Y, and Z are your trouble spots. Here's where the priority needs to be in order to maximize your value. All right. So again, Chelsea's going to send this out. She's going to send you a link to John Warillo's automatic customer. She's going to send you a link to the Value Builders US or the Value Builders .us landing page, so you can read about Value Builder and what we do. And then lastly, and Chelsea, oh, you know what? I got a couple questions to address before we get out. First, what's the number one fear buyers have when purchasing a business? The number one fear is that, what don't I know from the seller? How do I ensure that what that seller has in between their ears, the relationships they have, and remember the hub and spoke, that's the number one fear. And that's the number one thing that detracts from value. So that's, if I'm writing a check, I just need to be sure that I'm getting what I'm paying for. The next question is, how do we attract potential buyers outside of our industry? Well, there's a couple different ways. List the industries out that you think that would be applicable for you. I would go to your local library, and there's a service called Reference USA, and you can then look up those companies or those industries based on their SIC or NAICS code. And I would look at each one of those, look at the geography. Where does it make sense to from how far are we talking? And then I would compile a list. I've already given you the rule of thumb. You're looking at at least 5 times bigger than you as a general rule. So Reference USA has those sales numbers, so you can position yourself and make a short list of who might be a candidate. But again, like I said before, I caution you on going at it alone, because if you're doing it, you haven't done this before, or it's likely you haven't done it before, so you don't want to step on a landmine. So if you're going to have your accountant, attorney, or a broker do it, that they're used to doing it, and they can maintain that confidentiality a little bit better than you. Okay, so I think that's all the questions that that have been submitted. So next time, June 20th, same time, we're going to talk about the due diligence needs, and we're going to do a little bit deep dive into, here's all the stuff that everybody's looking for when buying, when to buy your company. And we're going to talk about financials, we're going to talk about legal stuff, we're going to talk about leases and all that. All right, so again, open shop. If you have questions, give us a call or drop me an email. Happy to help. And again, we're so grateful that you gave us your attention for these last 37 minutes. We'll see you next time. Thanks so much.